We've been reading and even listening to a lot of your peers from the industry, be it buy side or sell side, on caution which should be exercised on the small cap and mid cap side of the market. But what does pure data say? Has the valuation of say BSE 500 or mid cap or small cap indeed become quite premium to the large cap universe or not yet?
Yeah, thanks, Ajay. So the way we look at this whole broader market thing is that while if you look at just the valuations, the mid cap, small caps are around. I mean, if you look at it from a trailing earnings perspective, they are reaching the valuations of large cap more or less. So there is no spread between a mid cap, small cap over large cap broadly. But what is also important to note, the way the economic recovery is happening, the cyclical recovery is happening. If I were to look at some of these mid cap, small cap, their earnings growth will be also far superior to the large cap. So that's where the dilemma is basically. While the mid cap, small caps have outperformed significantly and leave very little room in terms of valuation gap, but the way the whole the investment cycle, real estate cycle, the capex cycle, infra, manufacturing, all that is picking up along with this discretionary consumption. It's possible that this space, not everything, but largely the index, if I look at it, if I look at the consensus numbers, it's expected to grow faster than Nifty. So it's that. I mean, it's a classic dilemma where valuations are not giving you any marginal safety, but then it will grow faster.
In fact, we were chatting with Sahil Kapoor as well on whether or not it's time to be a little cautious as valuations now seem stretched from DSP Mutual Fund. Let's hear out his, view, because he believes that broader market rally has become a little stretched.
This is, I think, about 5th month of rally for small and mid-cap stocks. Usually we've seen 6 and 7 months is where they tire out historically. Second, when you look at, let's say, the weekly momentum oscillators, for many of them, they are hitting extreme readings. We haven't seen them for a very long time. A third, of course, they have exited that cheap valuation zone that they were at the beginning of this year. They are no longer there. Thirdly, I think when you look at the market as a whole, when you look at the large caps, they are also not in the cheap zone anymore, right? So when we were at 17,000, there was a clear, comfort in terms of valuation. That comfort is no longer there. We are now trading in the top decile valuation that we've seen for Nifty for a very long time. So the conclusion is, I think right now we are hitting some sort of extremities. It's good to be cautious here, exercise caution rather than adding your incremental rupee to equity investments. You could probably look at multitude of other opportunities.
Right. Vinod, if I could just get back to you, in continuation with the view that we just heard from Sahil Kapoor as well, what are the frothy pockets from within small caps? And then should one be taking some chips off the table in that case?
Well, I think whole theme, it is, I think that index from March low, if you look at, let's say, the small cap, micro cap, it's 40-50% up. So I don't think there's anything as an exception. I mean, everything is rising over there, it seems. So I think, and there is absolutely, as I said, there is no valuation gap right now. But the point is, we have seen it in history that growth is what, and earnings surprise is what drives stock market and stock prices, even if they are expensive. But if surprises, the growth cup keeps coming in, then valuations can remain higher. Basically, that's the point. So we are not saying that the valuations will start falling, because that will fall only when the economic cycle reverts, basically, and starts falling. The economic cycle starts falling, earnings disappointment starts coming in, and that's where we typically see the P contraction, basically. So it will all be a function of earnings, how they pan out. If earnings keep surprising, then very difficult to say that P valuations will contract.
Let's talk about the power space. especially PFC, REC, 10-12% move. REC management was talking to us the other day on the channel and was telling us that they would go net debt-free. A lender talking about becoming net debt-free. And look at how valuations are from 0.5 book have become almost close to one-time book. Do you see scope for further expansion of valuations in PFC, REC because of stemming of T&D losses and good recoveries?
Yeah, so price to book ratio has a strong fundamental correlation with the return on equity and how the earnings, will look ahead, basically. So, in fact, a lot of these companies which are driven by book and are at reasonable price to book, and as the outlook for return on equity and growth continues to pick up, I don't see why the price to book should contract, basically, especially when they are not way above the 1 or 2 level, basically. So something at close to 1 price to book, as you said, and earnings visibility improving. So earnings outlook will be the thing. If these companies keep delivering on earnings, ROEs expand, are at respectable levels, then price to book at more than 1, 2 is, it could move beyond 1 for sure.
Your sense on the charts for, the likes of an NTPC, a Coal India, PFC, REC, is the rally here to stay?
I believe, yes. I believe that the rally is here to sustain for Coal India, for NTPC, ONGC, and such other names. These are PSU stocks, and we've seen what's happened to REC, PFC when these stocks managed to break out of their 8-10 years of downtrend consolidation for themselves, and these stocks went through a different kind of a trend for themselves, something which they have not witnessed over the last many years. I believe NTPC, Coal India, etc. are showing signs of such kind of a breakout. Now, what happens is in every part of a trend, you would probably see excesses being built up for the stock prices, where these stocks come back into overbought on the charts and then they still cool off. I think we saw a part of that happening for PFC, REC last week, where these stocks corrected some, I think, 20 odd rupees, 25 rupees respectively for these names. BHEL went through a pause, a correction of 10-15 rupees. Just to give an example from the PSU pack. So these kind of excesses would keep on developing, but I think for a longer term trader, trying to take advantage of that dip would be a more beneficial strategy.
All right. Vinod, one last comment from you. Which part of the market do you see really bombed out valuation? Something which nobody is ready to look at. People are completely written off in the market.
So we actually wrote a report recently on the valuation thing. And that's what we made out, that since calendar year this year, the number of investable value stocks, as we call it, basically companies which are at least for 13-14% plus ROE and available at earnings yield more than bond yield, which is a classic parameter for value stocks. Out of the top 1,000 companies, we had 17% of the universe exhibiting these traits. That has fallen to 10%. So the universe of value stocks is falling by the day. And so there is nothing which is bombed out, I think, at this point in time. Everything is rising, and which is a typical bull market scenario where everything keeps rising. So you have to keep looking at sectors where the growth continues. You continue to get surprises, because that's where these valuations will continue to expand. But having said that, if I look at the fossil fuel energy ecosystem, be it oil and gas, coal, or the power generators, and all these companies that just spoke about, these are still giving you decent value, I think. There are financials which are at reasonable valuations, and some of the commodity companies still offer valuations which are reasonable in my view. So these three spaces, I think there is still value, but nothing is, I would say, out and out bombed out or anything like that.
Vinod, great to have you on the show with those quick comments on the markets in various sectors as well. Good to speak with you as always. Let's just